the average can't beat the average. So if you add up everyone, if you add up literally everyone, they can't beat cap weighted because for everyone overweight, there's someone underweight.
Hmm.
So nothing saves the average active manager, sadly. But if you are arrogant enough, and I certainly possess this arrogance, to believe you're one of the good ones, a world that's less efficient in that way, that swings more wildly, probably should present more opportunities.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Welcome to the Bull of Wall Street. I am Jim Worden, Chief Investment Officer of the Wealth Consulting Group. We have Talley Leger joining us. He's our Chief Market Strategist, and our great friend Paisley Nardini, who's on our investment committee. We are super thrilled to have the one and only Cliff Asness join us today. And so welcome, Cliff. I'm just going to, your background, I mean, I could go on and on with your bio, but your PhD, University of Chicago, written lots of papers, won lots of awards. I think AQR, you're the co-founder and chief investment officer there. I think you're managing around 150, 160 billion?
A little less than that, I think, unless we had a really good day today. I've been paying attention.
Well, welcome.
Thank you. I'm thrilled to be here. The one and only. A lot of people breathe a sigh of relief at it being the one and only.
So we've had some other guests on here that have been kind of quantitative related. Jason Shu, we've had him on here before. We had Jeff Chang on.
Sure.
I know that's kind of, in a little bit quantitative space too, but we've had a number of economists and others, but this is the first time to really have a real true, I feel like, academic / hedge fund manager / quant on.
Oh,
so
you get me a little past my mathematical prime. They say mathematical ability peaks in your 20s, and I'm pushing 60. So hopefully I can do this justice. You get some wisdom as you lose the ability to do calculations. So we'll hope the balance comes out well.
Yeah. Well, I've got a lot of questions, but I want to turn it over to Paisley and Talley. I know they've probably got plenty of questions for you too, and just, things to talk about.
Awesome.
Absolutely.
Yeah, I'm happy to kick off. Thanks, Cliff, for being here. Just by way of background as well, not to anywhere near your extent, but I did spend the last 7 or 8 years at Invesco, which is very much a factor-based, more like the equity style factors. And I think something that's been gnawing at me, and so this can be pretty high level, but just thinking about, the underperformance of some of these well-known equity style factors, and value I know is near and dear to your heart. We can maybe even talk about small size as a factor and whether that anomaly is broken or if we just go through these cycles, but maybe just sticking on the value topic, because I know that transcends most advisor portfolios. As you think about what value meant 10 years ago, 30 years ago, 40 years ago, does it still mean the same thing today, or are we shifting in how we assess value? And I mean, even more specific, I think there's been a lot of discussion around the word intangibles. Is intangibles the new way to assess value? So I know that's a comment / a question, but I would love to just start there and kind of dig into that topic.
All right. There's a ton there, and I'm now going to use up our whole hour answering the first question. So
this is a 5-part series. You're here for 5 hours with us, Cliff.
I can't do 5 hours on this one. I could probably do 1 hour on this one. First, to back way up, the value factor, as quants and academics call it, and whether you've explicitly thought this, I know you guys would implicitly think this, is very incomplete. It drives non-quants crazy that quants call something like, at its simplest, price to book, long, low price to book, short, high price to book, value. Non-quants, let's call them, old school Graham and Dodd stock pickers who believe they're value managers would always tell you value is value in context of fundamentals, of margin for safety. Nobody rational should think you should pay the same multiple for a stock growing fast as one growing slow. For one safer, all else equal, at the same growth, you should pay more. So many years ago, when quants started studying, like the original Fama French work, sorting stocks by price to book, which by the way is still used as a benchmark. I don't know many real world quants who do it that simply. So I'll refer to it occasionally. I get very paranoid that people will think, 35 years later, since I started looking at this, I'm still just sorting stocks on price to book.
And
and
just
I'll get to,
not to cut you off, but I do think a lot of people believe that is still the measure by which a lot of screening with the quant lens is assessing value. That's a good place to start.
that does frustrate me. But people are not crazy. There's a reason they believe that. A lot of the indices were formed many years ago. Like if you look at the Frank Russell index, I think they may do a few other things, but price to book, I think,
They're still doing
at
it.
least features importantly in there. So if you're going to have a public conversation, if you're going to pull up value on your Bloomberg, it's going to have an influence. That doesn't mean
Sure.
that real world quants do that. You guys might know I love to fight with my frenemy Rob Arnott about various things, but one of the smartest things he did in fundamental indexing was have multiple measures, not just book. I think book usually makes it as one. I haven't kept up. Maybe it doesn't. But on the Graham and Dodd thing, so quants actually fully agree that price multiples don't encompass all of value, even though we tend to call factors based on price multiples the value factor. This was terribly misnamed. Quants actually, particularly over the kind of 30 years since Fama and French and some others, wasn't just them, in the late 80s, early 90s, were looking at this, have expanded the universe. There's a lot of stuff that people like us don't publicize. But of the public factors, profitability, low risk investing, factors based on investment, which are largely about buybacks versus issuance, all kinds of things that a fundamental Graham and Dodd stock picker would care about, are in the quant world and get weight in a lot of quant models. Certainly in our quant model, we would say holistically, if you add up our whole model, it's getting to be a pretty good approach to what you might call holistic value. But just multiples is what an academic will call value. If I can go back in time and have them rename that factor the low multiple factor, I think you could have stopped a lot of fights between quants and non-quants. With that said, it has historically been an effective factor. Even something like price to book. Price to book has been lousy for a long time. I've written on this. Most of that is because of a revaluation where the expensive have gotten more expensive and the cheap have gotten cheaper. Even in the 30 years since Fama French, when the factor's kind of flattish, if you account for the fact that it's cheapened, you still didn't make money. I'm not pretending that didn't happen. But if you didn't make money because something just got cheaper, you expect to make it back one day. If you didn't make money and the factor didn't change in value, that's just money gone. So I will, while saying it's far from all you should do, defend even the simplest versions of value because they're not based on measuring valuation perfectly. They're based on measuring valuation some degree of reasonably, and then saying, sometimes people think something like value or any factor, but particularly value, is dependent on the world not changing, on a static world. And one of my favorite graphs is the, again, super simple Fama French version of value, showing the growth of a dollar, long, cheap, short, expensive, as they define it, since 1926. And it has bad periods, it has crashes, it has flat periods, but it's done well. And I say, has this been a period of no technological change? No, we went from steamships to railroads. We introduced radio. We went to TV, rural electrification. We've done a few things
Sure.
since then. So I think of even the basic non-holistic value, just price multiples, as not saying the world is static, but saying, well, not static, human nature is more stable. So human nature says we're going to look at whatever's going on in markets. And on average, we're going to pay a little too much for what we're excited about and a little too little for what we're kind of depressed about. That is, by the way, the behavioral reason for value. There's a whole efficient markets risk-based theory that I still give credence to, but I've kind of drifted a little from over time, so I'm going to stick with behavioral stories. So I think even simple value can work. But with all that said, to Paisley's original question, there is no reason you don't try to make it better. Something like adjusting for intangibles. And I'll say it back. It's implicit in Paisley's question. I know she knows this, but for anyone listening, price to book is market cap divided by the accounting measure of what a firm is worth. It's paid in capital, in and out, with retained earnings growing over time. It doesn't have intangibles. For instance, if in the classic example of like an Apple, if you have a huge networking effect where it's impossible for people to leave your service. If I tried to leave my service, even my kids who should have their own service by now but don't, will rebel and yell at me if I tell them we're moving to Android, guys. Not happening in my family. And that's not in accounting book. It should be in market cap, right? We've been adjusting. I don't know. It's more than 5 years. It's probably less than 10, but we've been making some decent adjustments for intangibles for quite a while. Ironically, it turns out there are others, but two big categories of intangibles are things like R&D expenditure. You can think of another example of where you might care about intangibles is if someone spends a lot on R&D, the way it's done right now, that's expensed. That looks like you just spent money. But why is it necessarily different than property, plant, and equipment? Where property, plant, and equipment is not expensed. You have an asset that goes into book value, and then it presumably depreciates over time. But the day you spend it, you increase book, and if it was a good expenditure, the market values, you increase market value. So you're kind of not measuring that if you do it. Goodwill actually turns out to be more important. Everyone talks about R&D. I just talked about it first. But goodwill is basically you buy something out there and how do you reflect that in the balance sheet? Getting that more right than some simple price to book calculations can do, we find to be a bigger effect. So we do think you can do better. So I have kind of a dual strategy in answering this question. One thing is defending even the super simple. I worship at the altar of Fama and French. I assume they do some things in real life. They work closely with DFA over time. I'm going to guess they're not doing Fama and French 1992 anymore either. But a lot of the indices do. So I would say if I had to do the super simple original price to book, I would still bet a little bit of money that low price to book will beat high price to book in the next 30 years, but not nearly as much as I would bet as if I can measure it better. And it's not just adjusting price to book. There are a lot of other ways to measure value. One of our, enterprise value to sales adjusted for what industry you're in is one we particularly like. You get really esoteric. We have quite a few things in a value composite. Last time I checked, it was 25 or 30. I don't check every minute. They could tell me we have 200 ways to measure value now, and you're out of date, and you're old, Cliff. I was once at a conference speaking, and I said we had 15 ways to measure value, and and one of my own employees raised his hand to correct me, to tell me it was 25.
Like you could have done that after.
which I actually had fun with it, because I was like, I encourage people, if I ever say anything wrong to a client, I don't care about being embarrassed. I want to get it right.
Yeah.
But that was not enough of a difference. The difference between 25 and 15 was not material to embarrass me.
Yeah.
So he's
say to add a zero, maybe.
Yeah, but he was not removed from the firm or anything. So we are still believers in the value effect. It's a smaller part of what we do than it used to be. Not because we think less of it, because we think we found more things over time. It did recently rise up and try to kill us from mid 18 through mid 20, maybe a little more than 2 years. We ended up doing a very similar analysis to what we did back in the late 90s tech bubble. Remember, I've seen a few rodeos now. Value did terribly, but more than all of it was valuation multiples gapping out. It wasn't fundamentals. That life more than all came back for us in the next 5 years. But one thing, one of the good things about value is I think it's based on basic human nature, which changes very slowly, even the simple quant value. So I think there'll be a premium to it for the foreseeable future. I'll never say forever. One of the bad things is it's been historically one of the streakier factors. It goes through multiple good years and multiple bad years where things are kind of in favor or out of favor. You might get paid for being able to withstand streaks. I have colleagues who, eventually I'm going to let you ask another question, but I have colleagues who have a draft of a paper saying factors that are streakier, which is painful, right? All else equal, you'd rather a factor that if it has a 55% chance every month of going up, it's always 55.
Yeah.
Streaks are painful because 2-3 bad years, even if you get 5 good years after that, cannot be fun for a business. But their paper says on average, the streakier factors also make you more money.
Yeah.
So in a weird way, maybe the market is compensating you for being the one who can bear that.
Yeah.
But I'm not pretending it's not hard. I would not want to make my living as a pure quant value investor. I think if people gave me a 30-year lockup, I'd be okay. But I have yet to find an investor who's going to give you a 30-year lockup. About 2.5 years is about as long of a pain period I found people are comfortable with.
Yeah, maybe, and this is less of a question, but more of a comment. My takeaway from what you were outlining in regards to the value factor, perhaps support in an active management approach for the sheer fact you mentioned. A lot of the indexes, whether it's, a Russell 1000 value index, the way by which they're measuring value is a little simplistic or perhaps archaic, whereas active managers such as yourself and others have a more refined, robust process by which they can measure value, and it can evolve as well. So again, less of a question, more of a comment.
Well, Paisley, I'm certainly not going to argue with the idea that we're better than the indices. The indices do a bunch of things, like for instance, for the last 5 years, since what we think was this valuation bubble peak in COVID, value as measured by the indices, particularly in the United States, you get a little different result. Value's actually been better outside of the U.S. because the Magnificent Seven, for instance, are all magnificently in the U.S. Value has been a disaster in the published indices. The way real quants do it is generally global. It's generally using a lot of measures that are more robust to things like the Magnificent Seven than price to book. And for us, and this is a debated dividing line in the quant world, but we try to be very balanced by industry. We wrote a paper in 1995, so it's nearly 30 years ago, saying a lot of factors, but value in particular, have a tougher time comparing tech to textiles. If you take out some of the difference, if you get a little more apples to apples, risk-adjusted returns get better, and you find that kind of process, often you'll find some of the Magnificent Seven are long in that world. So it's not been a great period for pure value. It's been a great period for us overall because of some of the other factors. But quant value, and I think I speak for the industry more broadly. I'm not bragging. It's just us. Has been much more robust than looking at the Russell 1000 value against the Russell 1000 growth. That is cap weighted and U.S. based So that's really the Magnificent Seven against everything else. I
Yep.
usually don't know our position in the Magnificent Seven. We got 1,000 stocks long around the world,
Mm.
1,000 stocks short. Whatever our position is, it's not going to matter because it's not going to be that big. You don't want quants to take concentrated positions.
Yeah. No, I get that. Well, so one, I guess, follow-on question with that, because we have a model. It's not going to be purely quant like what you're doing, but we have a quant driven, meaning that we look at the factors, but there's still some fundamental stock picking going on. But momentum, is something we're looking at. And I know you look at that too. And then mean reversion. I mean, that in some ways, this feels a little bit like value.
Yeah.
What do you think about that? And you did a lot of work on momentum, working with Professor Fama, right?
Momentum was my dissertation did some other things. I'm oversimplifying, but a big part of it was sadly, I was not the first. I was probably the second major paper. You never want to be the second major paper on the price momentum strategy. And even that's gotten much subtler over time. How do you measure that?
Mm-hmm.
One major thing, and I'm giving you 35 years of history, is fundamental momentum. Good things happening at that level. It's correlated to price momentum.
Mm-hmm.
Because if you care about price going up and I want the fundamentals to go up, markets aren't crazy. They might not be perfect, but more often than not, the price is going up because something's going on good with the fundamentals.
Yeah.
But it's a much richer way to measure it. You make fewer mistakes. But I wrote a dissertation for Gene that focused largely on the 1-year price momentum strategy. Buy stocks going up, sell stocks going down. And one of the scarier things you'll ever do is tell Gene Fama, I want to write a dissertation on this. And then if you're like me and a coward, you mumble the second part and it works very well. And then this is a true story. Gene's like, what was that? And I'm like, it seems to work. And he paused for a second and he said something that still feels like quasi-religion in a good way, like his faith in this. He just goes, if it's in the data, write the paper.
Wow.
So I would say Gene has never liked the fact that momentum works, but he's very intellectually honest about it. He's often called it the kind of chief, I don't know, black mark era, chief thing that their famous 3 and 5 factor models don't handle well, that show excess returns against it. So we are believers in momentum. I would always rather have something cheap that has started to get better on some reasonable time frame. Again, I would have given you this exact same description in 1993. So the world has grown since then, both in how we measure things and in broader other factors. But yeah, if one is doing screening, even if they're going to do some post-processing with something less quant and more fundamental, I would generally include momentum. Mean reversion, your other question, can be very similar to value. There are a lot of different ways to measure mean reversion, but the original paper on this, and this is older than even me being involved, this was probably the 80s, although I could be wrong on that. It was by DeBonton Thaler. Thaler being Richard Thaler, Nobel Prize winner at Chicago. They wrote a paper on 5-year reversals. Just mean reversion, would buy whatever's been worse over the last 5 years, sell whatever's been best. And that actually was a good strategy. The losers tended to win. Sounds almost biblical. The losers shall be. I can't quote it chapter and verse. Ultimately, over time, at least for that kind of factor, that turned out to just be kind of a weak version of value investing. The losers did tend to be the low multiple stocks if you lost for 5 years.
Sure.
And if they weren't the low multiple stocks, that means the fundamentals fell more than the price did. So we'll use it on occasion in places where you can't get good value measures. Something like a commodity. Believe it or not, there's no real clean measure of value. So 5-year reversal might get a roll. But like in individual stocks, if it gets anything weight in our model, it's tiny because scaling by fundamentals is just better, right? Buying something because it's gone down. If something fell 50%, but the earnings fell 75%, if you're a PE type investor, it didn't get cheaper. It got doubly as expensive.
More expensive.
So mean reversion, I think, is mostly used in the quant world at a much shorter horizon.
Mm-hmm.
We are not high frequency traders, but market making, mean reversion at the higher frequencies is probably a decent part of what they do. So it still has a role, but at the longer holding periods, I'd always prefer a real valuation measure that I think is solid to just saying do the opposite of what I like to be a contrarian, but I'm not that contrarian if the facts are against it.
Sure. That makes
Hey,
total
Cliff,
sense.
maybe I could step in and ask
Please.
a question here. So, as you said, we've mentioned a couple times already, your mentor, Eugene Fama, is one of the fathers of the efficient market hypothesis, EMH for short. And correct me if I'm wrong. I guess you were starting to speak to it there a little bit, but I think you've written about markets becoming less efficient or more inefficient over time. And I mean, I would generally agree just because we wouldn't have jobs if they were perfectly efficient, right? But tell us, like, why is that? What's underlying that trend, and what does it mean for active managers?
All right. Well, this is going to be hour number 2. Um, First, I still, like I said, worship at the altar of Gene. This is, I believe, less in conflict with what Gene taught me than it sounds like. Gene taught the first year PhD in finance class at the University of Chicago, and he taught it for the same class that evolved, of course, but for like 30 plus years. And I took it, and then I was the teaching assistant for the next 2 years. And I was so nervous about doing a bad job, I sat through it every class. So I sat through the entire class 3 times. I've never done anything with, I can't think of anything in my life I've done that with. Somewhere around the 3rd week of class, Gene looks at the class. He's taught you about what the idea of efficient markets are, at least at a very basic level. And then he looks at the class and goes, now, of course, markets are certainly not perfectly efficient. And you get a little bit of a gasp, like, oh, I didn't expect Fama to say that. And anywhere else in the world, you don't get a gasp. In almost everywhere in the world, they have no idea what you're talking about, of course. But if anyone's heard of it, they go, of course, it's not perfect. Perfection is a really odd hypothesis. And Gene says that perfection is extreme. It's been a huge thing for the field of finance to have a scaffold to measure everything against. The idea that markets are efficient is where you start. You have to, and it's the right prior to start, right?
Mm-hmm.
To start with, they're easy to beat, for instance. It's probably a pretty dangerous way to jump into something. So as the base case hypothesis, sometimes to be rejected. Even Gene will tell you markets are not perfect. Gene might think they're closer to perfect than I do these days, and I might think they're closer to perfect than some. I'm still not fully abandoned. I still think markets are the best way to price securities. I'm not ready to abandon them to a committee. What did Churchill say about democracy? He said it's the worst way to govern ourselves except every other one that's ever been tried. And that's kind of how I feel about markets. They're not perfect, but they're pretty damn good at what they do. But once you accept that they're never going to be perfect, you can wide open for fair debate is how imperfect are they, and has that changed over time? And I was asked to write a paper for the 50th anniversary of the Journal of Portfolio Management. I was not around the whole 50 years. I've been complaining about being old on this podcast. I started publishing there in the early 90s, so 30 plus years for me. But one of the nice things about this is for those invited, these would not be what are called refereed papers. Meaning, I've been a referee many times. They're anonymous. They tell you why you're stupid and the paper's wrong. And sometimes they reject your paper. Very often they tell you, it's okay, but make the following 97 changes and maybe we'll accept it. I've done that to others. People have done it to me. An invited paper is the editor's going to look to make sure it's not, a total Unabomber rant. But they're mostly going to let you do what you want. And Frank Fabozzi, who's wonderful, who's been the longtime editor of the journal, encouraged a certain amount of opinion in this piece. It was supposed to be a bunch of old men reflecting on a long period. That fit the theme of the 50th anniversary. And I think this is what Talley is referring to. My piece there was entitled "The Less Efficient Market Hypothesis," and my argument, and I start out at the beginning of the paper and go, "This is as much op-ed as anything else." Most of the things I've written over time have tons of tables and data. These are like 2 data points of insanity I think I've lived through, and then some theories as to why the world went that insane. So this is a lot of, don't get me wrong, I stand behind the opinions. They are my opinions. But I want to be clear, this is not like where I can show you a 7T statistic and tell you, unless I made an error, I'm pretty sure I'm right here. This is opinion. But we lived through the dot-com bubble of 99, 2000, where what we saw over about a period of about 18 months, we saw, okay, imagine you sort all the stocks on your favorite valuation measure. It could be simple Fama French. It could be whatever subtle version that accounts for industries and intangibles, whatever one you want. Didn't matter. Most of them worked out to be about the same. If you sorted all your stocks on this valuation measure, the quant version of value, remember that's simpler than the Graham and Dodd version, goes long the low multiple, short the high multiple. That had a disastrous 18-month run. I know this because I started a firm 1 month before that run began, which was an unpleasant way to come into this world of asset management. But one thing no one had done, and I got to be careful, someone that might have done this privately, whenever you say you were the first to do something, doesn't mean 100 other smart people weren't already doing it. They just weren't stupid enough to publish it. I often joke, even at AQR, we publish a lot, but we wouldn't publish something if we thought it was great high alpha and nobody else knew about it. My running joke is the right time to publish something is 10 years after you've made a lot of money from it and an hour and a half before someone else is going to publish it.
So we're not going to get any trade secrets today. Got it.
You might, if you do, it'll be by accident. I do slip up occasionally, but we were the first public paper to go, all right, nobody ever talks about magnitude. The Fama French stuff, sort stocks goes long, the cheap, short, the expensive. No one ever, to our knowledge, had said how cheap and how expensive. Does that vary a lot? Right, you could sort all the stocks, and sometimes they could be reasonably compressed, where there's not a lot of big differences. Sometimes they could be very wide. We found in that paper that it was far from a good short-term strategy, but it was a pretty good long-term strategy to prefer even simple value investing when that spread was wider. And I think there's a lot of intuition there. Value works because people make mistakes. When the differences are bigger, maybe those mistakes are larger. And certainly by March of 2000, it was by far the widest spread we had ever seen in 50 years of the data. It blew everything away. It was a stupid-looking graph. It was one of these ones that looks broken, where it was like, hopefully everyone on the podcast can see I just drew that on my hand. So we survived that. We had a terrible period, but it was like 2 standard deviations bad. In geek speak, really stinks to start your new firm and get 2 standard deviations bad out of the box, especially when we started a fairly aggressive fund. Because in the real world, it's not just standard deviations that matter. It's standard deviation times how much risk you took. By the way, it should be standard deviations that matter. The quants are right. If you choose to take high risk, everything's going to be bigger. But when you post big numbers, you gather more attention in the non-quant real world. We stuck with what we did. This value spread we kind of invented gave us a lot of backbone to stick with it, because we were like, yeah, we're not wrong. Something really weird is going on here. Wonderful next 7 years. It made way more than all of it back. Life was good. But if after that bubble, and I do use the word bubble, which is not a Gene Fama word, you had said to me, are you going to see that again in your career? I don't think I'd say definitely not. None of us should say definitely about almost any question in our industry. Crazy stuff happens. But I think I'd say probably not. I think I'd say highly unlikely. It was the most extreme thing in 50 years. And the very question itself in your career nicely presupposes I will still be around. And I won't be the only one. There'll be veterans who saw this, right? You like to think maybe something crazy can happen after 50 years after Cliff is gone and his cohort is gone. So it's distant history. No one remembers it. It's a little harder to imagine when that cohort is probably not just around, but probably closer to running things, right? If you've survived in this industry for 20 years, hopefully you've advanced.
Sure.
So I would have said that. And then starting in about early 2018 and culminating in mid to late 2020, it happened again bigger.
Mm.
I could blame COVID, but that would be the dog ate my alpha. It's not a good excuse. Because it was approaching tech bubble extremes pre-COVID. COVID sent it screaming through tech bubble extremes. Post-COVID, you weren't supposed to own anything but Peloton, which
and Zoom, right?
Peloton, Zoom, maybe Tesla. Maybe the Tesla worked out, but the other two didn't. But COVID took it to unexplored new heights. But even before that, so again, the story was basically the same. We defended what we do. We've tried to diversify away from that. After making that money back, we said we don't quite. We could talk later if you want about how we think we can smooth that out going forward and maybe not ride that wave quite as much. And again, it's been a really strong 5 years for us, even though value only came back a little and didn't come back the Magnificent Seven way. But I did have to step back and go, why did it happen again? Again, nobody asked me the question 20 years ago, but if they had, I would have gotten it wrong. Why would I have gotten it wrong? And so a lot of this piece was coming up with hypotheses. And again, I admit they're just hypotheses for why we might be less efficient, and maybe more accurately than even saying less efficient, more prone to bouts of extreme inefficiency. Doesn't necessarily mean every normal day more crazy stuff's happening, but we might have, you can use the meme stocks unfairly as an extreme example of this. It's not fair to look at the craziest example and use that as your prime example. But if you remember not to cheat, to use it as an admitted extreme example, why do I think the world might have gotten less stable? I have a few others, but my two favorites from the piece are a very popular one people talk about all the time, the growing role of passive investing. I believe in passive investing. I think it's a nice anchor for most portfolios. I am not a hater of passive. There are, I know, Paisley, you work with Mike Green, so I'm going to be careful here.
No, he's going to be a guest on our podcast in early July. So whatever you say, he can rebuttal in a couple
weeks. Mike's brilliant. Mike's brilliant, but I put him in the hater camp.
It's the third hour of the podcast we just entered.
Okay, that's true. So it was funny because one of my main reasons why markets might be prone to these bouts more was the growth of passive, and I please no one. Because for people who really hate passive, I was rather circumspect. I wasn't pounding the table saying it is broken markets. And for people who love passive, I was blaming their baby for something. So, but here's how I think of it. I think of it very simplistically. We know the world breaks at 100% passive. No one even knows. It's hard to even get your mind around what that would look like. Nobody is thinking about how to value any individual stock. They're just trying to copy everybody else. Sure. So who decides if NVIDIA is worth more than the corner drugstore, right? We know passive has grown a lot over time. It's hard to precisely measure, and Mike points this out on occasion. You could have obvious passive like a Wilshire 5000 cap-weighted fund, but you can have funds that take very low tracking error that are implicitly kind of pseudo passive. So passive has grown a ton over time. We know the world breaks down at 100% passive. It is very hard for me to believe that it completely breaks down only between 99.99999% passive and 100. It seems like it almost has to be a curve where things get a little weird.
Sure.
And more and intuitively, fewer people thinking about valuation probably should lead. Now, this doesn't mean active management automatically outperforms. Sadly, Bill Sharp's math is tyrannical. Bill Sharp was, probably other people noticed it too, but I give the credit to Bill. And the average can't beat the average. So if you add up everyone, if you add up literally everyone, they can't beat cap weighted, because for everyone overweight, there's someone underweight. So nothing saves the average active manager, sadly. But if you are arrogant enough, and I certainly possess this arrogance, to believe you're one of the good ones, a world that's less efficient in that way, that swings more wildly, probably should present more opportunities.
Yeah.
My other reason I given it, which frankly I favor a little bit even more than passive, and here I definitely sound like an angry old man, is the social media 24/7 gamified trading world that we're in. Again, the meme stocks are an extreme, but I think at least helpful example where I always start explaining it like this. Most people I've met, occasionally you get someone disagreeing, but most people I've met, no matter what side of the political spectrum they're on, generally agree that social media has probably made our politics somewhat worse. We all, a lot of us live in our own bubble that just self-reinforces what we think. The promise of the internet 20 years ago was truth would be easier to find because we would all have access to all the information. And in a lot of cases, I'm not telling you anything you guys don't know, turns out having all the information at once, including all the false information, can sometimes make it harder. Curated sources and trusted sources are on the outs these days, but they weren't all bad. So if it's made our politics somewhat more worse, something more worse, it's not a good sentence, but or more unstable, markets are just voting mechanisms. They're no different than politics. You vote proportional to your dollars. Unfortunately, Elon Musk gets more votes than me, and I get more votes than the average retail investor. But it's still ultimately a vote. So this world where you could trade 24/7 based on rumors, my literal favorite way to explain this is this famous wisdom of crowds idea. We're all probably familiar with the idea that wisdom of crowds says if you get a whole big crowd of people and ask them a question. My favorite way to view this, and I don't know, Paisley, you look a little young for this one. You tell me if this makes sense. Regis
Not
Philbin,
offended by that comment.
Okay. I really was calling the other two guys old.
Exactly.
And
that's the way I took it.
It's all relative.
And Talley and I go to the same barber, so I'm allowed to say that about him.
You're lucky because I shaved my beard.
I shaved my beard once in the last 30 years over COVID, and my kids practically kicked me out of the house.
This guy.
We're all sheltering together, and they were like, "No, we don't even know you, man. We have no idea who you are."
That's funny.
But the Regis Philbin's how do you want to be a millionaire game show? It's this multiple choice game show. Questions get progressively harder. You miss one, you're out.
Yeah.
But you get multiple cheats. One cheat is phone a friend if you can't answer the question. Phone a friend was generally not that helpful. Turned out your friend was more often than not that much smarter than you. The best cheat was always poll the audience. And it wasn't that you had an audience of geniuses. The audience might be as smart as your friend on average. Who knows?
Yeah.
But if you have an audience that's not talking to each other, that's independent, and 20% of them know the answer, and 80% of them don't, and it's a 4-part multiple choice question. On average, there'll be some randomness, but on average, the 80 will fall 20, 20, 20, 20 over A, B, C, D, and the other 20 will all fall in the right answer. So you're sitting there and there'll be a 40, 20, 20, 20. And then you do the very complicated thing of picking the 40. There's a key assumption there, though. The audience has to be relatively independent of each other. If the audience all gets to talk and to vote, maybe the 20 who know convince everyone else. But maybe they're not the most outgoing or the most influential or the best at Twitter. If the audience all gets to talk to each other, then a wise crowd can become a dangerous mob very quickly. And I do think that's happened in our politics, and I think it's happened in our markets. If I'm right about this, it makes someone following a disciplined valuation process, hopefully broader, again, than just the narrow quant value factor. You should be able to make more money long term. If markets are less efficient, go the other way. If markets were perfectly efficient, there's nothing for an active manager to do.
Mm-hmm.
If they're less efficient, there should be more opportunity. But if that's all you're doing, it should also be a harder ride, because your very hypothesis is things can get wackier than they used to. And I didn't mention this earlier, but we've also seen the crazy prices can last for longer. The arbitrage mechanism has weakened. I don't think anyone cares what I find fair, but I find this remarkably fair. Something may become more lucrative but harder to do. Strikes me as still, even if it's less efficient, how markets tend to work. If you could supplement that with some other things that don't ride that cycle. In the quant world, we've looked a lot into what's called alternative data, being the first to new data sources that nobody ever put the sweat equity to write down. Some of those are fascinating. I'd be very boring podcast because I'm not allowed to talk about most of these. Their very nature. I could talk about value all I want, because I am not going to single-handedly convince the entire world to become rational and have no behavioral biases. If there's a source of data we think we're early to, that can go away really quickly. But can I tell you one funny story about this?
Yeah.
I'm talking to the Australian Financial Review, the Australia Wall Street Journal, as they call it. I don't know if other people call it that. It's actually a really good paper, so I shouldn't make fun of them. The reporter was really up on quant, and the reporter asked me about alternative data sources, which is not something everybody would even think to ask me. And I told him that our head of quantitative equity, Andrea Frazzini, give him a plug, has asked me not to speak about the specifics of what we do there for these very reasons. I could talk in general. It's somebody writes a data source down, puts a lot of time into building a 6-year data source, convinces you they will be able to update it on a timely fashion, negotiates with you on what you should pay for that data source. You pay a lot more for bespoke alternative data than you pay for book values on the S&P 500. In fact, the negotiation of whether you should buy the data is a huge part of the process for alternative data, when it's no part of the process for regular quant. Regular quant, we all buy the same data. They make their money, but it's not super expensive, and it's about processing the data better. But if the whole thing is this data source is special and will probably be special for only a finite amount of time, then whether you believe it and how much you should pay for it becomes a big part of it. So I tell the reporter from the AFR these generalities. I think it's really cool stuff, and I think we've been really good at it, and it's helped. And I brag that it's probably not as susceptible to the valuation cycle, which ironically can make you able to stick to the valuation cycle a little better, because if you're not putting all your eggs in that basket, when that basket suffers, you're in better shape, and you could be a more rational long-term investor. But so I tell him I'm not allowed to talk about it. What he writes in the article is he describes it all correctly, but instead of saying Andrea Frazzini has asked me not to talk about it, he writes Andrea Frazzini won't tell me what we're doing in alternative data. So again, won't tell me. So again, I'm over obsessed with this old man thing, but it was kind of like, yeah, don't worry yourself about it. You're up there. We're just doing stuff here. And I'm not at that stage yet. I promise you, they will tell me what we're doing. And often do. Sometimes I have to stop them because they go on and on. Yeah. But I found that hilarious, and there's no way to correct that. There's a good article in general, but somebody out there is like, Cliff's pretty disconnected from this stuff.
For the record, Cliff has not lost control, everyone. He is still at the helm.
Well, Paisley, I didn't say that. That's
my words. I'm the reporter now. Maybe as a follow-up, I know a piece that you penned earlier this year is like a hypothetical 10-year look back. So where are we in a decade from now, and what are we going to look back and think in regards to markets? And a big part, I think, or the messaging that I took away is kind of what can be viewed not so much as the contrarian trade today with the weakening of the dollar and some of the international flow attention. Alts have obviously risen to the surface as a useful diversification tool, but what is the catalyst, let's say in 10 years when we do look back? Not saying it's going to be the lost decade for US stocks again, but thinking about that main catalyst, is it valuation that's going to drive international attention and maybe more broadly, like the role that alts can play for investor portfolios?
Well, first of all, this piece was fun because it was all a thinly veiled structure to say, I'm going to be right about everything for 10 years, right? It was pretending we're 10 years from now and an allocator looks back, but that allocator is only giving a history of things that I believe in now, having turned out the way I claim they will. But to be really big picture, forecasting over any horizon is hard, but value is close to useless about tomorrow's stock market. Most things are useless about tomorrow's stock market. Momentum, to go to another extreme, is a useless thing. Imagine trying to forecast 10-year realized returns with 1 year past price momentum. Maybe you have some power for the next few months, if that's a good trading strategy, but it's inherently gibberish. Basically, valuation is the only way to...
Which drives capital market assumptions for most providers.
Absolutely. You know, if you have a strong, I was saying only way you saw me pausing, if you have a strong view that U.S. growth will continue to outgrow the world as it has, you can accord somewhat of a higher valuation without assuming lower returns. So valuation is still not perfect, and it won't be perfect in real life because endpoints matter. If you started out expensive but end up at the peak of a bubble, then valuation got it backwards, even over 10 years. Now, because in this theoretical exercise, you're not running real world money. Most people, again, don't have 10-year horizons for real world money. You simply say after 10 years, well, now we're going to be even more right. And I'm making fun of that, but it's probably true. So I will say most of what I did in this is based on valuation. The U.S. stock market, one of the key things I started with is saying the U.S. stock market has gotten way more expensive in an absolute and a relative sense, using whatever measure you like. People use the CAPE all the time and then argue about how bad or good the CAPE is. You know, you use price to sales if you want. Use what you like. They will, of course, vary at least slightly. They won't give the exact same result, but they'll generally give the same story. The U.S. has gotten more expensive versus its own history, and it's gotten way more expensive against non-U.S. stocks. In particular against non-U.S. stocks, this we find really interesting. If you look, and I think it was about 30 years, U.S. has crushed the world. You know, I don't remember, 4% more per annum, something, and that is a huge compounding effect. I could only be off by plus or minus 5% on that, so please don't quote these actual numbers. But the U.S. has crushed the world. But if you do the math on why, Antti Ilmanen, who some of you might have seen his stuff, AQR partner, has written the book Expected Returns. He's kind of not just my guru, but I'll brag for him because he's an AQR partner. I think he's a lot of the world's guru on very long-term expected returns. He's done a lot of this work along with his colleague Tom Maloney. About 85% of the U.S.'s victory has come from the U.S. multiple expansion versus the world. Meaning people for the same cash flows, earnings, sales, literal cash flows, book adjusted for intangibles. People were paying less for the U.S. than non-U.S. stocks 30 years ago and are paying more for U.S. stocks now. And call that a one-time capital gain, a revaluation. Notice this is going to be deep math and about as deep as we'll get on this podcast. 80% is less than 100. That means 20% was from actual fundamental outperformance of the U.S. They really did grow those various measures, earnings, cash flow, sales. They grew faster. A lot of that was the tech world and the Magnificent Seven, but that counts. You really did make that money. And I don't think that tends to mean revert at all. I think that's just money made.
Mhm.
You were right. It may continue. We could all be U.S. exceptionalists and say, I think the U.S. over the next 30 years will continue to outgrow the world, but it is now considerably more expensive than the
Mm.
world. And now, 30 years ago, if it kept up with the world in growth, it would have outperformed the world because it was cheaper. So if you buy something cheaper that then grows the same, you tend to win. Now it has to outgrow the world by more than the last 30 years to win it all. So yeah, I do go out on a limb and say I'm not forecasting disaster.
Mhm.
I think the U.S. There may be good reasons why it's valued higher than its own history. One thing we already touched on, the rise of passive. Passive may in fact justify a higher price and a lower required return on U.S. stocks. If you think about 50 years ago, the way my dad owned stocks, he had a broker, probably grossly overcharging him, and he probably had a clip-on tie, but that's all beside the point. But my dad owned like 6 stocks his broker recommended, paying very high fees
Yeah.
and taking a very large amount of risk because he owned 6 stocks. And one thing beautiful about passive, again, it may have distortive effects on the market. You can love it, you can hate it, but it's super cheap, meaning if the stocks go up, you get most of that return. And it's way less risky than 5 stocks. So it may be rational to accept a lower return because you're getting to keep,
Yeah.
gross returns don't matter, net returns matter.
Sure.
You're getting to keep it and you're taking less risk to get it. Lower returns can be perfectly congruent with a higher multiple. So I don't forecast multiples necessarily going back to all the way to history. I forecast a little less in the U.S. in the next 10 years than the past. I don't forecast international making back all of the ground, but I do forecast it beating the U.S. I go on in the piece. Yeah, please.
Well, so maybe this is a good way to summarize, and you could have answered this one already, but take us home because we're almost at the top of the hour. Are there any, or is there one current market narrative you think is flat out wrong or even overhyped?
Oh, you're asking me to
Hour number 4.
No.
We're doing well.
I was trying to decide if I would be mean or not.
Please be
mean.
I am not fully cynical about these. I've owned some myself over time, but I have been a public gadfly to the private investing world. That comes from a few different things. One, I think people just underestimate the risks. They are a private equity fund. We can talk about private credit separately.
Mhm.
It's a newer thing. It's harder to get your handle on. But private equity is levered equity. It has driven me crazy. I had my first fight about this with the private equity manager at Goldman Sachs in 1997. It was something called the Asian debt crisis. That was like 19 crises ago. But the S&P was down 7% in a day, which is still a huge number. It was a funny day because our P&L system, real time, on some of our first early accounts that at Goldman that became AQR or became what we do at AQR showed we were up a ton. But that is because we were short the US and long Asia. One great way to look like a genius is to be short a crashing market and long a closed one. So for one day, I benefited from not marking things to market. We had guessed that we'd be flat when things opened the next day, and we were thrilled with flat because we were claiming to be market neutral. So to be flat on a crash day was fun. But then the head of Goldman's private equity came over, and he says, "How you guys doing today?" And I don't let him look at the screen. I just say, "I think we'll be about flat when it all settles." And he looks at me and he says, "That's great. Us too." And I go, "Wait, aren't you levered long, cheap mid-cap stocks?" And he's like, "Yeah." And I said, "If you were going to sell them at the end of today, you never sell privates in a fire sale, but intellectual exercise. If you're going to sell them today, wouldn't you get a lot less than yesterday? He goes, a lot less, but we don't have to sell them. To which I responded, neither do we. Right? There are always two ways anyone can mark something. They can mark it, or anywhere in between, but two extremes. They can mark it at what the market will pay today, or they can mark it at what they think it's worth. Why do privates get to mark things at what they think it's worth, or at least somewhere in that direction, and I have to mark it at what the market says? When we've had our toughest periods, I could have pointed to the spread between cheap and expensive and said, no, we're not down. Our money is in the bank of short crazy. and that bank's going to pay us back with interest. And in fact, it did. I think that would be unfair of me. I did not tell my clients that. I said, we're down, but I expect to make it back. But I've never understood the private world could do it in a heartbeat. They're brilliant, genius people at valuing companies. They could tell you in a heartbeat, based on market prices today, this is where we could sell the portfolio. But somehow, for legal and cultural and traditional and path-dependent reasons, we do it a different way. If anyone fully gets this, privates are fine, as long as you're assuming, but you still see, and you guys might see it. And if you guys do this, don't even tell me. Let's just leave it out of the podcast. But you see efficient frontiers where people have private equity 4% vol, public equity 15% vol. And if I had hair, I'd pull it out with that. And so that can have two effects. One, it could make someone over-allocate to equities if they actually believe it. And maybe long-term, that'll be a good thing for them. But if the downs last, privates are great if you have a one-year down that bounces back. But thank God we haven't seen this in a long, long time. But if we have a real 10-year bear market, you run out of rope on that and you discover, gee, I had a lot more equities than I realized in a bear market. The other one is much subtler. If you go back to not the origin, private investing's been around since the Romans had some private equity, I'm sure. But probably the late 80s, where David Swenson at Yale popularized the endowment model. He was a brilliant guy. He called his book Pioneering Portfolio Management, and it was very well named. He's a big advocate of privates. But if you go read why, it was because they should earn an illiquidity premium. They should earn a premium because who wants something illiquid that you don't know the value of precisely, or someone won't tell you the value of precisely, maybe more accurate, that you can't get rid of and buy something better if you want to. I think this is personal opinion, but I think it's pretty clear in the 80s and 90s and for a long time, illiquidity, David was right about it. Illiquidity was viewed as a bad thing, a bug that you had to withstand, and you earned something for being able to withstand that bug. I think over time, for many investors, it has morphed into a feature. That it is easier to stick with something if you're not told the market value and not able to act on it if you were told. Now, if you had the self-discipline simply to not act on public things, you can replicate this without paying kind of giant fees. Yep. But if something is viewed as a feature, well, with a feature, you accept a lower return for getting something good. Yeah. And by the way, this still might work out for the private people. They might be right about the behavioral psychology. Them acting better might on net overcome, even if I'm right that they're getting a lower baseline return. The better behavior might counteract that. I don't dismiss that. But it also means if an investor just grits their teeth and says, I don't need the what I will sarcastically call the ostrich version of valuation, I can take it. You could do even better. So I do think the next 10 years are not going to see a private disaster, and there will be phenomenally good private managers. Obviously, there's going to be huge variance among them, but I think the average premium of private to public already disputed. There are people who will fight about what it's been because it's not simple as markets. You get IRRs, not total returns from point to point. So there are big fights about exactly what the premium's been. but I think it will be lower and correctly adjusted for the same level of stock market investment, the right volatility and beta, if you will. I think there is certainly a chance it is a negative premium, and that was part of. So that's the one I would nastily end on.
Yeah, I would say to your point, you use the word variance. I usually use the word dispersion of manager returns. There's just a lot more selection process. So
Yeah.
if you're thinking about due diligence purposes, you better pick the right one. And then ultimately back to your conversation earlier on capital market assumptions and valuation based, most investors, especially in the advisory space, don't have a 10-year time horizon. Liquidity needs today, next year, in 2 years. And so a lot of these lockups, especially in the PE space, require them to have a 7, 10+ year time horizon. So I think that mismatch from that education perspective solves a lot of that kind of friction. But I also work for a liquid alt shop, so I am biased.
Yeah, as do I. I'm talking my book. Everyone should know that. But I do think you're right that a lot of institutions are right now thinking, did we overestimate our ability to lock up capital for that long? The private world's not going away. It's an important part of capitalism, but that doesn't mean it's offering what it did 20 years ago.
Yep.
So, Cliff, I got one last question, if you don't mind.
Not at all.
So when I was out there at the, you had your AQR University, which I think you always do a really fantastic job. If anyone, by the way, listening, AQR does a fantastic job at education when it comes to AQR University. So I was listening to you, a
bit of a pretentious name, though, don't you think?
No, it was good. It was all good. University of Chicago Gleacher Center. You get to see all the pictures of all the Nobel Prize winners.
Oh, that's inspirational. You feel very academic.
I love it. It feels like you're right there. But Brian Kelly was talking about AI and machine learning, and he went through this whole discussion of fewer parameters is better for academic, looking at these things and analysis. And then he flipped it on its head and said, actually, with AI, more parameters is better. And so I'm just curious what your thoughts are, where we're going with AI. How does this get better? Does it amplify and make worse kind of human behavior? It feels like it might, but it feels like it also might help bring a little bit of rational, logical thinking back to investors that might not otherwise be rational and logical. Just curious what your thoughts are.
Well, my main worry about AI is are there going to be any jobs for my kids? But I'm not above worrying about that, and I have no answer to it. My wife has spent a fair amount of time trying to figure out exactly what jobs will be less affected, and we've not really solved that one. But Brian's point, in general, let's start with the non-ML situation. Estimating parameters. The more you have to estimate, effectively, the less data you have. You're spreading the data over over more tasks at one time. When you go to ML is just particularly good at that trade-off between overfitting and inclusion, or whether something should be included. So you can push it further. But I want to be clear about one thing. These can't be random numbers. Complexity is good if the complexity has some truth to it, some prior belief that it makes some sense. Even with ML, if you just add gibberish, adding gibberish, even if ML will deal with it a little better than an overfitting old school model.
Sure.
It's
still gibberish.
Bad. Yeah. So it's basically Brian's way of saying ML is just better than we used to be at dealing with more complex situations. And for those who don't know, Brian is an AQR partner and a Yale professor and kind of an expert on ML as it applies to financial markets.
Fascinating. Super, super interesting. Well, we sure appreciate your time with us here, Cliff.
Come and dance on our floor. Take a step that is